Group Statements, Chapter 7, Example 7.2. In Example 7.2, we look at the scenario where there's a value adjustment required on non-depreciable assets and the subsidiary does not account for the revaluation in its own records. B Limited acquired 100% interest in the net assets of S, and 1 January 20X9 is my acquisition date. On this date, the trial balance indicates the property, plant and equipment land in the books of S at 100,000 Rand. On 1 January 20X9, the acquisition date, the identifiable assets and liabilities of S were considered to be fairly valued, except, so I'm in Chapter 7, the land of S was undervalued with 20,000 Rand. So that 100,000 up in the trial balance of S was undervalued by 20,000 Rand. It is, however, the accounting policy of S to account for this land in terms of the cost model of IAS 16 property, plant and equipment. So that tells you that S will not be able to value adjust that land of 100,000 Rand in its separate financial statements. And that does not constitute an error in the books of S. IAS 16 allows the cost model as an accounting policy for property, plant and equipment. If we follow the consolidation process, we now have to determine whether there's any business combination valuation journal entries necessary for this example before we do the at-acquisition consolidation journal entry. To help us with that decision, we follow a specific work method. In the separate financial statements of the subsidiary, the land is measured at 100,000 Rand. However, because of the requirements of IFRS 3, this land has to be fairly valued for consolidation purposes. And the fair value for consolidation purposes is 120,000 Rand. The value adjustment of 20,000 Rand at acquisition date was not recognized by S because S follows the cost model as an accounting policy. As a result, my starting point being the trial balance of S is different from what I want the land to be measured at in the group financial statements. Consequently, this identifies differences. And the moment you have differences between what's recognized in S and what's required in the group financial statements, we need consolidation journal entries. The following consolidation journal entries is necessary for the differences identified. To recognize this value adjustment on the land, you have to create an equity item at acquisition, which is your credit revaluation surplus at. Together with that, you need a debit to the land of S, because it's the land of S that is undervalued by 20,000. By writing this journal entry, you have now created an equity item for that 20,000 difference at acquisition date, which would now be part of the subsidiary's equity to eliminate. And you have created a debit against the land of the subsidiary for that 20,000 Rand. Once you've written that business combination valuation journal, you can now do the at acquisition journal, which would be to debit the share capital of S, debit the retained earnings of S, which you've seen before, and now you debit that revaluation surplus at that you've just created with your first journal. Against that, you eliminate the investment. If you didn't create this revaluation surplus 20,000 Rand through the first journal entry, this at acquisition journal would again have generated goodwill, which is incorrect. So back to the example in your textbook, you have now written a consolidation journal entry where you've created this revaluation surplus at balance, which is now available to be eliminated as part of the at acquisition consolidation journal entry. If you didn't create that revaluation surplus equity item through a consolidation journal entry, you would not have had it available to eliminate, and that would have resulted in an incorrect goodwill. In example 7.2, the consolidation was done immediately after acquisition on 1 January 20X9. Would it have made a difference if the consolidation was done at 31st December 20X9? Your answer is no. The normal consolidation procedure, as set out in Chapter 2, where we repeat all our consolidation journal entries for consolidations at any date since acquisition, will be applied. Both the journals that we've just looked at will have to be processed again on 31st December 20X9.